Great, thank you, and good afternoon, everybody. Thank you to Adani Renewables, thank you to ETC, and thank you to the Science Museum for hosting us. I will make sure we finish on time. I know it's the end of a long, hot week, but I want to make sure we really get our money's worth out of this great panel. I want to start by saying that I seem to be making a habit of following Adair around, not just following on one panel to the other, but of course, I've been involved in the ETC since the beginning, and it's been a fantastic source of very practical insights, both from the quality of the analysis and also the inputs from all of the member companies. But of course, I've also followed Adair as a chair of the Climate Change Committee, where he was the founding chair. And although I think I can say that I'm probably having to deal with slightly harder politics than he had to, I think it's also true that all the work that I and the committee and the team do very much follows from the very solid commitment to rigorous analytical research and transparency that Adair pioneered, and which really pioneered internationally. And I see just the last 2 days, I've been speaking to ministers from Indonesia and Korea who are keen to, in their own way, learn from and mimic the work which Adair pioneered. I just because we're in London Climate Action Week and there's been a lot in the press about the UK policy on climate, I just wanted to make a couple of remarks about the last 3 things we published, which will all kind of come to a head this week. So in May, we published, I think, really quite a breakthrough report called the Well-Adapted UK Report. Our Climate Change Act requires us to tell government every 5 years how bad the problems are going to get in terms of adaptation, but it didn't tell us how to prescribe solutions. Well, we've changed that now, so it much more follows the mitigation approach. And that report basically said we've got a really big problem in extreme heat, which we're living this week, so we were proven right. In flooding, we had terrible floods in the West Country where I come from in the first quarter of this year, and in drought. I mean, and one of the tragedies of our failure to act on climate change fast enough is that those 3 things are all lived experience in the last 12 months in this country. The UK farmers lost £800 million of revenue because of the drought last summer. The other recent report we had last year, we published our advice for the 7th carbon budget. You know, in the UK, we have this system of legally binding 5-yearly emissions targets, and our advice was that should be set at 87% below 1990 levels for the period 2038 to 2042. And on Wednesday night in the Houses of Parliament, that was voted on and passed, like all the other carbon budgets, although for the first time there were opposition parties voting against it, although the leaders of the Conservative and the Reform Party didn't turn up. I think, interestingly, we've done a lot of work to try and do some of the debunking of some of the nonsense that started to be. You know, we have people saying that the transition to net zero will bankrupt the country, right? Which is patently not true. It's going to deliver massive economic benefit, hugely improve the balance of trade, and in particular give us fiscal stability. The Office of Budget Responsibility in the UK did an assessment of what would the impact be of one fossil fuel price spike per decade if we didn't make the transition to net zero, and they came up with a figure of 13% increased borrowing as a percentage of GDP. We have a GDP of about 3 trillion, so that's £400 billion that we would have to spend just for rent extraction and for zero build if we weren't on this trajectory. And in fact, our latest research, which we published the week of the Iran invasion, was that the total net cost of investment over benefit in the next 25 years will be less than the impact of one fossil fuel price spike. Of course, we also have some people saying unbelievable things if they expect to be taken seriously by business and investors. People saying that they would rip up private law contracts granted for long-term renewable energy provision. So we've got some really silly politics in the UK at the moment. I would urge all of you to be quite vociferous in pointing out where silly assertions are made with no facts behind them, and it's part of our job as the Climate Change Committee to provide those facts. And of course, the last thing I'll say is that we, on Wednesday, published our annual progress report, which is the way that the Climate Change Act requires us to hold the government of the day accountable on whether the policies being put in place are sufficient to reach our legally binding targets. And very much on cue, our number one message was that this government needs to take electrification much more seriously. There's been a very big focus on clean power and lots of good progress being made. You can argue about costs and about trajectory and about all the details, but actually that's been a project over many governments in terms of institutional reform, which is continuing. But there's not enough clarity on particularly electrifying domestic heat and industrial heat. And there's even a bit of a wobble on electric vehicles. And to Adair's point earlier about the importance of understanding exponentials and technology cost curves. That's probably what I spend most of my time obsessing about. We are very clear, I think we're all here very clear, that EVs are going past the point of price parity, sticker price parity, because of that inexorable innovation curve. But we actually still have a Department of Transport which thinks that price parity won't be reached for a couple more decades, which is kind of unbelievable, because it's so predictable. And if you make those wrong assumptions, you set wrong policies and you miss opportunities. I also finally I just want to shout out to Aaron for mentioning Holcim's Science-Based Targets Initiative. That's something which I founded in 2014, and Gonzalo, my colleague, who was the COP25 high-level champion, and I put at the heart of the race to zero in COP26. And we have well over 10,000 companies who've made that commitment, and it's driving innovation, just as you illustrated. Back to the panel, the other thing which we launched in Glasgow with Mark Carney, of course, was GFANZ, the Glasgow Finance Alliance for Net Zero, which famously mobilised, air quotes, a coalition with $150 trillion of assets under management committed to net zero. And what we're going to talk about in this panel is how you turn that stock into a flow, because one is not the same as the other, and it's certainly not automatic. So we've got a great panel. We have Robbie Singh, who's the group CFO of the Adani Group. We have Sean Kidney, the founder and CEO of the Climate Bonds Initiative, and Rhian-Mari Thomas, CEO of the Green Finance Institute, and who between them know more about mobilising large amounts of capital than almost any. So I'm going to take my seat now, and I'm going to start with Rhian-Mari to ask her to give us a little bit of the framing. So Rhian-Mari, just help us get a size of the total scale of capital that needs to be mobilised in the transition to net zero, and then maybe narrow it down a little bit to the power system. And then I'm going to come to Sean to talk about bonds in particular, and then Robbie to talk the practical experience of Adani.
That sounds very... Hello? Yep. That sounds a very organised way of running this panel, Nigel. Thank you. Good afternoon, everyone. I feel I'm in the survivors' party here. So big question. How much capital do we need, and how much capital is actually moving? One of the things you did when you were UN high-level champion was commission Lord Stern and Vera Songway to actually start putting a number on all of this. And the number that sticks in the mind is between 4 and 5 trillion a year out to 2030. The good news is, according to Bloomberg New Energy Finance, last year, $2.3 trillion of global capital flows invested in the clean energy infrastructure and technology space. That was up 8% year on year. It is twice as much as was invested in new oil and gas exploration. But as I just mentioned, it was half as much as the academics tell us we actually need to be deploying. But the interesting thing to break it down is which sectors are attracting those capital. And the top three are electrified transport, renewable energy, and power grids. What those three sectors have in common from a financier's perspective is they are all well-established, mature sectors with clear business cases, clear cash flows, clear revenue models. It shouldn't be a mystery that that is where capital wants to invest. So that sets us up with the challenge of how do we get more money into some of the emerging technologies, first-of-a-kind technologies, not just electrification, but alternative fuels, carbon dioxide removals, hydrogen. How do we get money into jurisdictions that are absolutely critical for the transition and yet are perceived to present higher risk? So we're talking about the emerging growth markets, particularly in the global south. And the third challenge is, of that 2.3 trillion, a significant portion is still public capital, or money from development finance institutions, etc. And we all know that we're going to need to mobilize the commercial markets, the institutional investors, the private capital, if we're going to get to these numbers. The good news is, despite some of the nonsense you might be hearing in the media, private capital is still fully committed to this thematic. It is fully committed providing the risk-adjusted returns meet their hurdle rates. That has never been in doubt. Unfortunately, maybe in some of the exuberance of a few years ago, some of us might have thought that those with their hands on the levers of capital were willing to do things that would look a little irrational in the short term, because we were winning the moral argument that we are facing such existential threat that perhaps we should lower our returns expectations and our yields in order to invest. I believe the pendulum will swing there one day, but unfortunately we're not there yet. So in the meantime, we work with the markets where they are, not where they should be. And the markets are not asking the governments to fund the transition, but they are asking for clear industrial strategy, clarity on clarity on direction through clear industrial strategy and policy, de-risking where it is required through a whole bunch of mechanisms, most of which we have precedents for already, and for actually crowding in the private capital, not crowding out. Do not compete with the private capital. We can get into a number of examples there. But without sounding too Pollyanna-ish, at this end of this long, hot week, I think there is a lot to be optimistic about when it comes to actually mobilizing the capital. Lots of conversations this week as we are finally, I think, moving to a more honest conversation about what it's going to take to move money rather than an ideological one.
Great, thanks, Rhian-Mari. I'm going to come back to. I love you talked about emerging, and then you said growth markets. And one of the bees in my bonnet is, can we stop saying emerging and developing economies? It's a term of art which basically screams risk to investors. And in fact, often we're talking about the most dynamically growing economies, and talking about opportunities in growth economies is very different from opportunities in emerging markets, even if they're the same places on the map. But we could come back to some of your thinking about how we mobilise the domestic capital in support of that in a later question. Sean, you've been driving exponential uptake of or issuance of climate bonds since you launched Climate Bonds Initiative. It seems like a lifetime ago. Now, give us a sense of the growth that you've seen and what's driven that, and maybe with a bit of a geographical overlay.
Sure, but let's go back to growth markets. Just a quick question. How many people in this room think there's a chance the Indian government will ever default on its debt? How many people think there's a chance the US government will ever default on its debt? Right, fair number, okay, right. I think the US government is currently AA plus to AAA, and the Indian government is BBB plus. Hey, there's some things we could do that could make a big difference to your interest rate, to other people's interest rates in that area. I do have a call of S&P next week because I said this on Guildhall and they immediately phoned me up. We've got some problematic methodologies in how we assess risk and growth here. And this is a big discussion. Now, what we're looking at is how we can mobilise investors into this conversation. First, because the bigger investors, universal owners, more than $100 billion AUM, the people we speak with, do their own internal risk rating, usually. And they need to adjust their methodologies too, but they're often using S&P and Moody's as a starting point. And hey, we've got work to do. Some investors are already there. Like KES, for example, has got a very big exposure to India because they actually see it as lower risk than everyone else does. And they've lost some money in some parts, by the way. But there is a real question of breaking the risk growth current understanding. You're absolutely right. But what Nigel's talking about is the green and sustainable bond market. So the purpose of our work in this area has been to engage, energise and excite institutional investors, 150 trillion of them or so, who have a long-term mandate as well as short-term mandates. These are the ones who have to pay your pensions when you retire in 20, 30, 40 years. By fiduciary duty, they have to make sure they match assets and liabilities. And it's difficult in the context of climate modelling. Now, you can argue about whether value destruction is going to be 2% or 25% by 2050, and Adair's done a lot of work on that in the past. The current models of gentle linear change out to 2050 suggest a 3% value destruction by 2050, and as we've discovered this week, linear is not how it's going to work. What we have is, in fact, volatility risk, huge volatility impact, and when we start grappling with the modelling of that, which is very hard because there's no real precedent, we actually find lots of moments of value destruction, etc. This is a risk for them. They don't know what to do about it. But if we can give an instrument that performs short-term and also address long-term, they think, whoa, what's not to like? And that's why we've had green and sustainable bonds, which have grown from $2 billion outstanding when I started to now just about to hit $8 trillion US outstanding as a market. So call it a proof of concept that investors will invest. Now, We've still got to get interest rates down. There are still macroeconomic issues, risk perceptions, and so on. There's also trust perceptions that this stuff really is future-proof. Well, with solar, we can make that argument. But in other areas, like cement, how do you tell, Arun? It's really difficult. Well, there's been some work done, Nigel's done some work, etc., etc. That's what ETC's been working on so long. We're now working on resilience criteria. And we've seen Tokyo's first resilience bond for flood protection and storm protection and so on, which proved the point. It sold at the same levels of subscription, 7 times over subscription, 5 basis points lower interest rate they get for the normal bonds, AAA, in the London markets, by the way, as a proof of concept. We're going to get they're actually in the market again this week of double the size bond. We're going to see a lot more proof of concept to show that investors will invest. Now, just to assuage Rhian-Mari's concerned, it's not sentiment, by the way. There's a way market dynamics work. Basically, a bonus feature, secondary market. We find that green bonds don't have volatility. They have reduced volatility and, weirdly enough, most excitingly enough, increased liquidity characteristics compared to US Treasuries. When the bond market froze in March of 2020, US Treasuries stopped getting bids for 2 weeks. Investors told me they were still getting bids for their green bonds. So if you're a portfolio manager, this is gold dust, and that drives it. It sort of doesn't matter. We could have done it with Marmite bonds perhaps, but we made it work with green bonds and sustainable bonds, and now it's a big market. We need, though, to be able to grow this to where it is. Our official publicised target is 30 trillion by 2030, well above the 8 trillion that's there now. What have we got to do? Well, we need to provide extra support for this. Investors are keen. Rhian-Mari's right. I speak to institutional investors in all major markets. They all tell me their biggest problem is supply. They can't get enough bonds to meet their risk yield requirements, as Rhian-Mari says. We need to provide some preferencing. We need to educate them about credit risk guarantees. We need to bring guarantees in. Since 1790 in the US, 15% of all debt in the country has had a public guarantee on top of it for various policy reasons. That's how the US built its economy. It didn't build it with just free market forces. Now, there's some weird stories in there we don't know to go into, but that you get the idea. Now, we need North guarantees for South. It's currently single-digit percentage growth. It's got to be a lot higher. We do need policy support, and this is the fun area we're getting into now. We've managed to mobilise investors around the world. They're keen. So when I was in Canada last week, we started talking with the Maple 8, the major funds, about working with the Canadian government on measures that the government could take that would be fiscally efficient for the government and, if we get it right, voter efficient, that will enable vast quantities of capital. This is the dream of investor public sector collaboration, but we've got to make it specific. What do those specifics look like? Well, in India, a conversation of Mahindra says, I'm conscious that Adani has vast green hydrogen plans, but how do we ensure that there's enough offtake agreement? Do we need to worry about that? Robbie's, I hope, going to tell me in a minute, not a problem. We've got the price coming down. But in the meantime, certainly in China and in Japan, we've got a price problem. Green steel is 40% more expensive than ordinary steel at wholesale. But for a car, it's only 1 or 2% more expensive by the time you add everything else. Tax credit for Mahindra, 2% tax credit, would that be enough to get Mahindra to let some long-term contracts to do green steel? Well, Mahindra tells me it would. They tell me it would. I think we've got a collaboration here between Mahindra, Adani and the government to get these plants going and fund them and make offtake agreements viable to a baseline. We can do this in concrete too. In Mumbai, if we had a plan, let alone in London here where we have not done this, crazy enough, if you have a zero carbon building, which includes the low carbon concrete iron that you're talking about, and green steel, you get an extra 4 stories. Very simple. Every developer in London and Mumbai will be doing this if you control the height in that kind of fashion. There are things we can do that investors want to see. So we're in the middle of mobilising now, at least this stage in Canada, Japan and Brazil to begin with. You have investor councils talking of governments about measures the governments can take. It's working. The last thing I'll mention is in Japan, where thanks to a meeting that the chair of Nippon Life, who's also the chair of the Green Transformation Agency that I'm an advisor to in Japan, who's also now the chair of the Business Association that Cartman had the Prime Minister, she came out with policy a week later saying, you're right, energy security equals clean energy. Japan is now ramping up its clean energy ambitions, clean energy, because of that engagement from the investment community. There's going to be a lot more of that happening in the coming world, but we need the detail now of the fiscally efficient measures that we can sell in for different kinds of industries. And that's where I hope ETC is going to deliver a detailed agenda for me.
Thanks, Sean. You remind me of the London Stock Exchange earlier this week where they were talking about their work they do looking at a kind of climate risk overlay onto sovereign ratings. And I don't know, I'd have to go and look at the report to see what they say about India, but I know they underweight the USA and they overweight the UK. In other words, their view is that the US economy, both from a transition and a physical risk point of view, is
Brazil is so pissed about this. Yeah. So we're talking to them about how we work with credit rating agencies.
And we might come back to some of your ideas around off-takes later, but I want to turn to Robbie now. Robbie, first of all, Sagar gave us some of the headline numbers, but just give us a sense of the scale of capital deployment that Adani's undertaking. And you shared when we were talking earlier how big that is in the context of the whole country. Just give us a sense of the scale, and then I want to get into tackling some of the myths around the cost of capital blocker in growth economies.
I'll start with the story of how I actually first time spoke to Sean. And so to those who don't know me, I'm free speech absolutist, so I'm sorry if anybody gets offended. But see, when we were starting out in 2016-17, it was very important, we thought it was important for us to have someone like Climate Bond Initiative score or rate our bonds. And they refused. And they had their reasons. I understand that. Sean's a good friend. So one thing became crystal clear to me at that point in time, that there is an aspect called that we are investing and we are committed to invest and we are doing X, Y, Z, versus taking foundational investment decisions which are independent of any of this. We have never considered since that day, I promised myself, that we at Adani will assume the following: that no commitment of anybody in this field has any value whatsoever to us. Zero value. Because when we laid out our plans in 2017, we said that we'll be roughly around 20-25 gigawatt by 2025. That would have put us on track to be the largest developer of renewable power anywhere on the planet. And we were denied access to that capital, which had said we are committed to invest in this field. So we had to engineer a way to invest. We are roughly at that. We are 20 gigawatt of solar and wind power operating and 5 under construction this year. And we have about 3.5 gigawatt hour of batteries operating. So we are basically where we said we will be. In addition to about another $10 billion investment we had to make at Adani Energy Solutions into HVDC lines to directly transport green power somewhere. So so when we look at this, for us, immediately the thing was that the scale at which we wanted to invest, the maximum, if I assumed that time that every Indian bank could give us their maximum credit limited exposure, and every investor in the emerging market fund invested the maximum of what their exposure limits were, we would be about a third of the size. So what we did at that point in time was, we said, this is nothing to do with sustainability, this is nothing to do with renewable, this is nothing to do with saving the world. We will make money. So we basically said, we will do this, and we will make return that exceeds the return of any other electron chain. And that's how we got the capital. We just went to everybody normal. We just raised, issued bonds, normal bonds. Well, they are rated investment grade, the same rating as Government of India. And we just mobilized normal capital. And the good part of that was, you throw enough money, people dance. So we had enough of the returns were juicy enough. There were a lot of dancers. So that's how we had to. And on the scale of it is that we have roughly about $100 billion committed to the energy transition. We overall have about $200 billion of planning commitments, of which we are very clear that within the next 5 years, we'll deploy about 120 billion. We are not crystal clear on the path. We have 6 years, very detailed pathway. So 120 billion, will 100% deploy. We don't care about what happens in the world, wars, this, that, other. If something doesn't happen to India, we will deploy $120 billion unconditionally. Rest, we have to still work through investment planning requirements. And that of that $120 billion, the domestic market can support us for give or take about 60% of it. Our global partners would be another 40%. Although all of the risk capital, which is equity, that is just ours. So we'll deploy all of the risk capital. So in that, we will deploy close to about 35 to 40 billion of our own equity and about 60-70 billion of global debt capital. To put that in the context, that is outside of China, that the single largest concentrated development risk being undertaken by private sector in renewable space by a company.
I think earlier you were saying that's 25% of the private capital being mobilized in India is.
We as a portfolio, we do about just give or take about 27% of all of the private sector investment in this space in India.
So can I just ask you just a sort of, there's I think, I don't know if it's received wisdom or a myth in a lot of circles talking about the need to mobilize climate finance, that emerging, or as we're now going to call them, growth markets, because they have a higher cost of capital, whether it's fair or not, it's a fact. It's very hard to mobilize large amounts. Now, just say a little bit about, you say your rating is pegged by the national rating. Because you're reaching concentration limits, you're having to go beyond domestic capital providers. So you're introducing FX risk. Just give us a sense of where in your total cost stack are you having to pay more, and roughly how much, and where are you saving money so that you're still coming in as a profitable project? See,
sometimes what happens in finance is that if we focus too much on the headline rate, I mean, the key aspect is what is your risk-adjusted cost of capital, and at what duration.
Yeah.
So what you want to see is what is your risk-adjusted sustained cost of capital, and for us, when we model a generation. So what we do is we say, okay, if we take an investment decision, then over a 30-year period, what is the cost of capital we want to have at that risk? In that 30-year period, you now have to account for event risks, wars, so-and-so disruption. You account all of those, you do event risk modeling, and you go through that. Now, when you look at that aspect, the current headline rate is irrelevant. Because when you look at, which Adair and team were talking about this, when you look at a 30-year period, we are getting the benefit of the technology dividend. We are getting the benefit of the building blocks that are underlying compounding. So consequently, you are on an exponential curve that is not currently parabolic. It's still going. So you are saying, okay, now what happens is that in that scenario, if we can assure execution in a certain framework at each of those blocks over that 30-year period, we as equity can accept that higher risk position ourselves. Moment we accept that position, the current rates over the 30-year period are perfectly fine because we are pricing a duration into our sustainability. And that's where that a lot of the climate finance and sustainability folks, the aspect that the duration capital, okay, and to understand the sharing of this exponential value gain and the technology dividend, okay, if this sharing is understood appropriately, then the cost of capital that is currently available for on a risk basis for investment into energy transition is actually remarkably cheap. We can beat the ceiling of India simply because we can offer a lower risk structure of these parameters. So we have to go through those parametric aspects. And what happens if you get stranded asset risk? What happens if you have a technology shift? What happens if you go to triple lamination from current single lamination and so on and so forth? So you have to layer this out and say that this is part of our operating and development and investment structure. And these are such high, the value that Adair and team were saying, the value of the energy curve coming down in relation to the electron price from renewable sources, that value exceeds the cost of capital by a factor.
Right.
So if it is 8% to 10 basis point change, there is irrelevant number.
So once again, as we've talked about, having a really clear sense of where the technology is going becomes a really important part of assessing risk. I want to make sure I finish on time.
It's more than that, and I've got to pick up Robbie's point earlier. The arguments we had all those years ago, 10 years ago, was basically around investor perceptions of transition plans. Our board, made up of large investors, weren't happy with putting a stamp on the Adani debt because they felt that Adani at that time had a huge coal mine in Australia, which would have used up the rest of the world's carbon budget in one go. And they said, we need a transition plan where they're planning to leave their coal mine. In practice, that's what actually happened. But at the time, they were looking for, we're saying now, clearly, this is shaken out a bit now, because of course what we want to do is reward positive. Now there is still a discussion in Europe going on about entity commitments versus use of proceeds commitments. And what Adani ended up doing is issuing, in fact, the whole pile of very successful green bonds as part of that. But it is a debate still going on, and I'm coming down quite strongly today and saying what counts is the positive stuff. I do think the coal mine at the time was a problem. I understood what investors said, but the practice was you were actually moving. You couldn't tell me the time to change. And this is one of the difficult things of assessing the transition plans of companies. How do we pick the right kind of investors? Because above all, we know we need. This is what ETC's been pioneered. We've got to support companies to go from brown to green. That's the game. That's the most important thing to do. That's what the economic challenge is to do. So our journey together on this issue exemplifies that changing perceptions. I feel like we've got there.
Yeah, no, I don't want to. Sean is a friend of mine, so I take the liberty whenever we catch up for breakfast, we catch up all that stuff. So it's nothing. I have nothing personal, but I wanted to highlight that there are ways. We have a pathway. The pathway is that all of this makes economic sense when you look at it over a generational period, and the consequence of generational equity loss, if we don't do this correctly, is too horrific to consider. So therefore, it is a generational economic value. We know how to monetize this generational equity value into current investment planning, and we will continue to do that. So we are a little bit immune from this sort of the rate discussion. What's helpful now recently has been is that the overall understanding of the sheer scale of the transition execution that is in front of us. Like, while 4 trillion is a number, 4 trillion is not nearly enough in relation to what I think to move. Anything that moves in the world has to go electric. Okay, anything that moves, any machine that moves, any part that moves has to go electric. So when you look at that, then its number is much higher. And we are not at that level. So consequently, I think that we are willing to share. We share that openly. We make up papers public. They're on our website. So people can look at our finance planning. People look at our investment risk planning. And the idea is to share that in a wider way. And we have a lot more buy-in now. We have a huge level of pushback still in Europe. I don't know for what reason, but so Europe contributes about 6 or 7% of our total capital, but US contributes this global percentage. Asia contributes percentage, but the only place we really struggle with, I don't know what the mental block is Europe.
Great. I mean, there's also this. I think we've seen. If I talked about GFANs, I think 5-6 years ago we were very much talking about. Still, there's a whole concept of trying to reduce financed emissions. Now there's a much more emphasis on transition planning, which I think is a much more sophisticated approach. Look, I know we're near the end of time, but I just want to pick up, Rhian-Mari, when you're talking about what's moving. Now you said that most of what's moving is renewable energy, EVs, and grids. So I just want to see if there are any insights from the panel on how do we mobilise capital for the other bits of electrification, particularly some of the things that we talked about earlier where there are still quite high upfront costs, so that we need maybe a slightly more sophisticated approach to justifying the finance. And Sean, you mentioned a bit about offtake agreements, but any thoughts on things like in the UK, for example, financing the transition to domestic heat pumps is a real challenge. So any thoughts on the bits of the electrification finance journey that are a bit harder to reach at the moment?
So I've got lots of very granular examples that I could give about how you do this, but I think they could be a little dull. So instead, I'm going to take what I think is a key lesson from this panel, which is you're sitting here with the sources of finance from the green bond fixed income market and the uses of finance through a developer who had projects that they were willing to actually deploy that capital into. That is finance 101, right? Whenever you actually look to model any transaction, you have to look at your sources and your uses. And yet, strangely, that deal-doing discipline is often missing in a lot of the discourse that we have on this topic, which is why we have a landscape that is littered with public-private partnerships and funds that are set up and very well-intended supply of capital that hasn't identified the vehicle that is going to deploy it. So what are the lessons we take from that for electrification, first of a kind, any of these new technologies? It is if we were to actually adopt more of a deal-doing discipline, one point that you made, Sean, you would define your end objective very, very clearly. What is your specific sector, your specific geography, your specific outcome that you're trying to achieve in gigawatts? And then you work back and you go, what are all the aspects that I need? What does my value chain look like? Starting with government setting targets and setting commitments. Financiers can't actually finance targets and commitments. So you need to turn those things into the right regulations and policies. You then need to make sure that you've got the right institutions that can actually deploy government capital. You then need to structure that to bring in the private capital. And if you're successful, you end up creating a new asset class or a new way of investing that is so vanilla, that is so well accepted, that that's when the institutional capital can pile in and we get to the 30 trillion by 2030, alongside other investment vehicles as well. So it's that idea of transactions through to transitions that is actually a pretty new idea, because I think we've been so overwhelmed by the challenge. It is global, it's huge, it's existential, that there's been a temptation to think, well, we just need to green finance. What are the big levers we can pull? As opposed to thinking, how do we avail of finance? How do we finance green? And it is those transactions, be them electrification or any of the other first of the kind, that we actually now need to pursue in earnest, not just through collaboration, but through genuine coordination behind very well-articulated specific outcomes.
Yeah. Actually, I think we have an interesting example in the UK right now where Ofgem have just qualify the first 16 of the next wave of long-duration energy storage projects, and of course there's a price mechanism now, which is the main thing, which is going to de-risk those projects which get the first contracts. Final thoughts, Sean and Robbie, on the hard-to-reach bits and how we unlock capital for
in
them.
2024, 95% of electricity generation investment on the planet was clean energy. Guys, we've won. Look at Adani. We've won. We're moving in that direction. Last year, it might be down to 90% because data centers. We launch it. We have just launched the Greening AI Data Centers Coalition. If you want to know about it, come and talk to me afterwards. All the global building standards companies, investors, and a whole lot of customers like AWS in that coalition. There's so much that's already been done. 2, in Pakistan, second thing, Pakistan, it's gone from 0 to 13% for solar in 5 years, I think it is, with cash. No debt, no nothing. Cash and YouTube. No networks, no experts. YouTube videos. Thank God for YouTube. Who would have said it? This is what's happening around the world across Africa right now. It's not that complicated. But if you want a bit more complicated, look at Australia. We've had battery subsidies for the last couple of years. The government has ended up paying out 3.5 times more than they expected in battery subsidy. $1,000 a subsidy, not a lot, but it has been phenomenal. You heard Greg Jackson talk about it before. Gas is kind of going. The demand for peaker gas is disappearing in a fluff of battery usage. And of course, generators are making more money because they no longer have a negative rate in the middle of the day. It is going so fast. It is unbelievable. And I've got one virtual power plant company in Sydney who is so excited about the opportunity of using car batteries, as Greg was talking about. They're doing the economics on giving away electric cars to their customers in return for being able to use their batteries during the day without using them power plant. Guys, this world is in the middle of a revolution.
I think that's a round of applause. Come on, I got that in it. Robbie, final thoughts, the hard to reach.
There are two clear pathways. One is we have a lot of dumb systems and they need to become smart. So for example, currently we are in the midst of rolling out one of the planet's largest smart meter program in the country, like that is Adani Energy Solutions, and making dumb machines smart. So you want to create a data backbone, and that becomes a access point to reach areas which you otherwise would find difficult to reach. It allows you to distribute, and it allows you to chop off peak. And so that will happen to making things smarter, and we are bringing the cost down of making things smarter. The second part of it is that we are also working on it in Silicon Valley. Obviously, a lot of the companies are also working on it. We hope to come to a point shortly, which is the second pathway to this, is that we will actually make the chip itself not require any operating system, etc. to operate. So consequently, we'll embed a part of AI onto the chip itself, so it's a processor. So when you do that, so to give you a tech speak, my apologies. So like normally, if you don't use the chip, you are using equivalent frequency of about 3,000 hertz. You embed the same thing on the chip and exactly get the same outcome from that one electron. And now it's about 20 hertz, so it's 150 times less in energy use. So consequently, so this will happen, and it's happening. So we are deploying what we call edge compute. So this is basically what that is. So you deploy the edge compute, and it allows you to reach areas where otherwise you would not reach. That is industrial installations, and that is industrial machinery, which is standalone sometimes, which is in remote areas sometimes, which might not have the grid support sometimes. So when you make this reach that part, it allows you to convert the nature of that system, and when you convert the nature of the system from fundamentally in terms of its operating architecture, a real life example. If we were to, which we are trying to implement, which is that the vertical hierarchy of organization shifts to a horizontal one, and the impact of that is, say we need 5,000 acres of land to build a power plant, it compresses down to about 3,000. So land because you now don't need. You only need 9-meter wide access for fire safety because people aren't moving in it. So there are many of these things that come from having a data spine and being able to reach that. And so there is a significant alteration at industrial level that's going on. It's difficult to see at the moment because it's not large enough. But what you will see is that as we deploy this in a larger scale, so we ourselves will go from 20,000 edge compute places to, which is basically edge data center sitting on a chip, to say in our case, we'll have about 50 million of them. Immediately it becomes obvious. So it's going to become obvious one day
So I think I want to pick up on that phrase as we wrap up. I think you're talking about changing the nature of the system. If I think about domestic energy use in the UK, right, it's typified by 3 completely separate, dumb systems. Electricity for lighting and sometimes cooking, gas for cooking and heating, and petrol. And in the future, the future that we're moving towards is 3 smart, interconnected systems. In fact, one of the things that I've been talking about lately is that in the UK, the way we talk about energy bills is still anchored in the past. We have an archetypal household that Ofgem defines, which is electricity and gas. They forget the EV, they forget the car. And one thing that I'm saying is we need to have an archetype of a fossil fuel house, petrol, gas and electricity, an archetype of a future electrical house with the full technology stack and all the smartness built in, and talk about the impact of policy on those 2 households. So, because we need to sell that future much harder. And I think between the 3 of you, you've given us a great story of just how much the finance is flowing to that future, but how much more we've still got to do to keep selling and demonstrating that future is inevitably smart and electrified. So with that, thank you to a great panel, and let's have a drink.